man, please.
Yeah.
Please, I'm going to open up insurance, put $2-3 million in my insurance and borrow from that and put it back in.
What could you do with $1 million from your policy? You can fund a business. You can fund and buy more real estate. You can take advantage of opportunities that might come your way. In a case in music, he might fund his next record or records, sign on his new artists from his own life insurance policy because he initially funded it with $2 to $3 million, allowed it to earn a rate of return, allowed it to earn an interest rate, and through the interest he's earning through the life insurance contracts, he's able to loan it back out of the policy without paying a dime of tax and fund his next deal. Hey, oh, let's do it. Oh, let's do it. Hey, let's do this conversation about what WAKA, FLOCKA Flame said about life insurance. Quote, open up insurance, put $2 to $3 million, borrow from that. What are we talking about in this episode? We're going to break down what WAKA, FLOCKA meant in that interview, what I perceive he meant in an interview, some strategery. We're going to show you game in this episode of the 7 Figure Squad, starting in 3, 2, 1. Let's go. Psst, come on over here. Let me show you something. This is all life insurance right here, life insurance. And not for my clients, although we've helped over 28,000 clients just last year in 2021. But this is all life insurance policies for who? For my family and I. Now, I'm not a financial advisor. I'm simply a licensed life insurance agent building national agencies across the United States. And I want to break down what WAKA FLOCKA was sharing here, some areas that a lot of people got excited about because they didn't realize that life insurance has these tax strategies and tax advantages and opportunities that a lot of people thought that was just for either the rich or for people that was going to be buried in their funeral one day. So let me just share with you a little bit of baseline, a little bit of foundation in why a lot of people get their money wrong. This is not something that you just say, okay, I'm gonna watch one video, I'm done with this. You need to reach out and say, this, I need to find some wise counselors and advisors who have been there, done that, who've been through some good times, been through some bad times, and still living to talk about it. One of the strongest structures in the history of humankind is the triangle, the pyramids of Egypt. And when you build your foundation of your home, you want to build it in an area where it's strong, no matter what happens, weather, changes in environment, this structure will stand strong, like your house, like your financial house. So at the bottom of your financial structure, when you're building your financial home, the first thing you want is certainty when it comes to income, certainty when it comes to cash flow, because no matter what happens over here with life insurance, whatever you decide to put your money into are fancy words such as asset allocation, diversification of your financial strategies. No matter how fancy that may all sound, if you don't have the finances, the cash flow to fill it and fund it, the best plans lose. So you have to find ways to make sure you solidify your cash flow first. I served 8 years in the United States Marine Corps. And I didn't learn any of this stuff until maybe my last year in. Why? Because I went through some financial challenges. I got married, divorced, filed bankruptcy, found myself in a very bad position. I found myself as a single father in custody of my kids. So you have to address this thing called risk. And usually in this conversation about risk, that's when I stumbled across how to mitigate and minimize risk, which is through life insurance. The next things you should build upon then is your savings for emergencies and opportunities. Next, you have to have a debt management strategy for good debt and bad debt. And then you start talking about your investments. And then you start talking about a 401k. And then you start talking about stocks, bonds, mutual funds, real estate, crypto, collectibles, etc., gold and silver. The challenge with a lot of people, though, they got their money like this. It's all turned upside down. Instead of building a solid financial foundation from the bottom up, it's from the top up, where the investments are the first thing they talk about, and then real estate, and then debt, then savings, and let's figure out this thing called cash flow. The sad thing about where a lot of people think about money is just finding ways to get rich quick. The best strategy is how to get rich methodically over time, so therefore it lasts. So here's what you should do. A couple things that you should consider. Number one, you should have a plan for your next moves. What's the next moves? As soon as I get my budget together, as soon as I solidify my income, as soon as I solidify this, that, blah, 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 what's my plan? What's my next moves? Am I happy here? If I'm not happy here, I need to have an exit strategy. If I'm working on plan A and plan B is not where I want to be, that then becomes then plan B. You got to find now a plan A you're transitioning into. So plan your next move. Number two, you need persistency, commitment, urgency. You need to surround yourself with wise counselors and advisors. You never surround yourself with people that are just not YouTube gurus or YouTube channels like myself. Like if you're seeing this video and you don't know who I am, please don't rest upon this video to help you make your decision with your finances, or in this case, your insurance. Please take this video, read these books, watch many other videos to fill up your mind to help you create an educated and well-informed decision. What most do, however, is they fill their life with impatience, with desperation, get rich quick, type of opportunities. They're lazy, don't really want to work it, so therefore they wing it, and they only teach themselves. They're self-taught. Listen, I get self-taught, but if you want to learn a very important topic, such as life insurance strategies, such as planning your financial future, is a very important thing that you surround yourself with a lot of people that have been there, done that, versus you just trying to figure out as you go along. Because a lot of these folks who have been there, done that, the perspective they can give you is time and experience, which you do not have yet. So here's what you should do, here's what most do, and what most people think about life insurance. Oh, it's only for older people. Oh, it's only later in life. Oh, it's too expensive, I can't afford it. Oh, it's unnecessary when I'm single. Oh, I got insurance right, I got it at my job. Listen, this is not what we're talking about. This is not your granddaddy's policy. This is not a group policy. This is not your job's policy. This is an individual life insurance policy and strategy that we're discussing here. Oftentimes people think, okay, let me just get the typical term insurance policy, okay? Term insurance policy. Let me explain, let me go further. So sometimes people go, there's two ends of the spectrum here, okay? There's two ends of the spectrum. People can say, you know what? I'm going to minimum fund my financial strategy, my insurance strategy, and this is what usually term insurance is all about. So the term insurance says, let me get the least amount of cost for the biggest amount of death benefit. That's my style of life insurance. But the challenge with this term is that you have to have a demise of yourself in that term. You put $50 a month into this thing for a 30-year insurance policy for a 30-year period. So $50 a month policy every month for 30 years, for a 30-year period. In exchange, from day one, the moment you put 50 bucks into this policy from day one, is something, Lord forbid, were to happen to you, a $500,000 death benefit in this example would be paid to your beneficiaries. And that's where most people think that life insurance is all about. What WAKA FLOCKA is talking about here, right? He says, open up insurance, put 2 to 3 million and borrow from that.
Man, please.
Yeah.
Please. I'm going to open up insurance, put 2-3 million in my insurance and borrow from that and put it back in.
Well, I'll break it down even further, because the other side of the spectrum is actually what he's talking about, where you maximum fund a life insurance contract with as much cash as you can contribute to it, okay? Based on the availability and the insurability of your life. And what also, we'll talk about some tax guidelines here on what you can shove into a life insurance policy by maximum funding it. You want to have the minimum life insurance afforded to you by the IRS tax code that you can shove all this cash in and still qualify under the definition of it actually still being a life insurance contract by minimum death benefit and maximum funds inside the policy, by stuffing a lot of cash inside this particular life insurance contract. So what motivated this video is that we published this video with my reaction to what WAKA FLOCKA said about financial literacy and what he said also about life insurance. He said, open up insurance, put 2 to 3 million in it, and borrow from that. What WAKA FLOCKA said with 2 to 3 million bucks, you can break this down to $200,000 to $300,000 from your gains in real estate, to $20,000 to $30,000 that you may get from a bonus or just saving your money over a period of time, or $10,000 to $12,000, $13,000, $15,000 that you say, you know what, I got some money here I want to save and possibly have a gain for my future. How do I do that with a life insurance contract? And I'll share with you, there's many different ways to do with it. What WAKA FLOCKA is talking about is permanent life insurance, okay? Over here, we're talking about term insurance, where it's the least amount of cost for the most amount of death benefit. A different mindset comes to you looking at life insurance from a financial strategy to accumulate wealth and to be able to draw from it without paying a dime in tax. By the way, he didn't even mention that in this video. He didn't talk about not paying a dime in tax. So you can accumulate this money inside properly structured, maximum funded life insurance contracts and withdraw it or loan from it without paying a dime in tax. And what permanent life insurance structures, basically what he's talking about, is permanent life. And that's a style of life insurance. There's one style, which is term insurance, which I explained before. And the other style is permanent life insurance, where it talks about stuff in cash inside it, and what are some of those characteristics of permanent life insurance contracts? There's whole life policies, there's universal life policies, there's variable life policies, and then there's index universal life policies. I dare to think that he may not be talking about the variable life policy because this is one of the four that is not guaranteed. It's tied directly to the ups and downs of the stock market and the least appropriate life insurance policy for this strategy. So for purpose of this video, I'm just going to X this out of this conversation and assume that he's not using variable life insurance policies. Again, one of the most risky policies out there in the marketplace. And oftentimes people who have not gotten advanced training on life insurance, who still have training from the 60s, 70s, and 80s, think that permanent life insurance policy is all but one policy, which is called whole life. Watch, you'll see even in the comment section below, people talking about whole life, whole life, whole life, whole life, whole life, thinking that that's the only style of policy within inside permanent life. There's whole life, and then there's, in 1980 was created universal life, and then in 1996 was created index universal life. So there's three different iterations of life insurance that fits the potential strategy when somebody says, I want to put money inside a strategy to accumulate wealth, not paying a dime in tax as it's growing, and then withdraw that wealth without paying a dime in tax legally and ethically according to the IRS tax code. So what WAKA FLOCKA is talking about is maximum funding life insurance. Maximum funding permanent life insurance contracts. And there's a little bit of history behind this. So what happened in 1982, a tax code was passed called TEFRA, Tax and Fiscal Reconciliation Act of 1982, which basically created guidelines for life insurance to qualify as a certain definition of life insurance if you have lots of cash inside these life insurance contracts. So then they defined what a modified endowment contract meant, which means that any money that's inside a life insurance policy can still be transitioned to the beneficiary upon the demise of the owner without paying a dime in tax under IRS Code 101A, okay? So if you die with a life insurance policy, any money that you have with that life insurance company will transfer to your beneficiaries without paying a dime in tax. So it included not only the death benefit, but also the cash value. Now, let's say you had $100,000 inside a life insurance policy and it was a modified endowment contract. WAKA FLOCKA cannot put $2 to $3 million inside a life insurance contract and enjoy its tax benefits if he wants income tax withdrawals down the road. So if he just shoves $2 to $3 million into a life insurance policy from day one, then it will automatically turn into a modified endowment contract, and thus he cannot withdraw money since he's under 59 and a half years old without paying any penalties or income taxes. Because under modified endowment contract laws, if you take money outside a modified endowment contract, which is a life insurance policy that now lost its tax advantages, you have to pay a 10% penalty, just like an IRA or a 401k, and income taxes on the gains that you have inside the life insurance policy if now your life insurance policy is deemed as a modified endowment contract. So people didn't like that. And next thing you know, DEFRA was passed in 1984. Deficit Reduction Act in 1984. And then in 1988, TAMRA, Tax and Miscellaneous Revenue Act, was created in 1988, which said, okay, if you want money inside these insurance contracts, you have to pay what they call, you have to follow a corridor called the 7-pay or the MEC guidelines to have money inside life insurance in a tax advantage way. Meaning that if you're under 50 years old, which WAKA FLOCKA is, he can basically shove $2 to $3 million inside a policy in a 3 installment period time frame. Or if he's somebody's over 50 years old, over 4 installments, 3 years in one day or 4 years in one day, installments into a life insurance contract. Now, with that being said, if that's what he was doing, if I'm not his financial advisor, his business manager, or his insurance agent, I'm just presuming what he said. I'm just trying to break down what we've done for clients that fit this type of profile, that you filter this money in. So let's say you have, in this example, let's say you have $3 million. Now you're filtering in $600,000 over a 3-year period or a 4-year period. You got 600 grand basically going inside a policy. So I kind of put together what you would see on an insurance ledger, okay? So if you're working with an insurance agent and they understand these strategies, then they will know how to create an illustration for you that fits the guidelines of 1984, 82, 84, and 88. TEFRA, DEFRA, and TAMRA, and avoid a modified endowment contract scenario where you are taxed later on If you want to withdraw this money for income or investment purposes to invest in other things or to live on, you don't want that. But if you want to make sure you have tax advantage guidelines down the road, you have the opportunity to do that. So this is a ledger, okay? This is a sample of a ledger from a properly trained life insurance agent that understands these strategies, but this is generally speaking a ledger you would see inside a life insurance policy. Because traditionally, what a lot of people think, 401k, okay, I'm saving for my retirement. So let me break this down right quick. These are different retirement plans that all come from the Internal Revenue Code. See, these retirement plans, when people say, I've got a job, I got benefits, and a 401k, well, it's IRS 401 Chapter K. You're usually working for a for-profit corporation. If you're working for a nonprofit corporation, a CDA hospital, or a school, you most likely will have a 403B. If you work for the city, a municipality, you usually will have a deferred compensation or what they call a 457 retirement plan. You work for the federal government, it's usually called a TSP, a thrift savings plan, or you're working for the unions, you have a pension, okay? So all come from where? The Internal Revenue Code. So these companies and or the individuals, you can put your money here and have significant tax advantages. But insurance falls not under 401k, 403b, 457, TSP pension. IRS falls under, again, IRS code 7702. IRS code 7702 of the Internal Revenue Code. So your life insurance agent should be familiar with these strategies. Obviously, WAKA FLOCKA is an insurance agent that properly educated him, made him aware, say, hey man, compared to anything that you can put your money into to grow and compound and to protect yourself from losses in an economy, losses in the stock. By the way, whole life, if the stock market crashes, if interest rates go high as they're doing right now, and the economy has a massive crash, guess what a whole life policy will still promise to pay a policyholder? The dividends it promised to pay. The interest rate that the universal life will pay. Same thing here with the index universal life policy. The tracking of the S&P 500 or the Hang Seng index or the Russell 2000 index, whatever index, whatever indices that an index universal life policy will track, it'll make sure it records the gains, but none of the losses. That's why a lot of people love these strategies love these particular policies for the strategy, because these three policies, not the variable life, will remove you from exposure to stock market and economic losses. So when you're looking at IRS code 7702, what you're combining is, how do I get access to my money in a short period of time before I'm 59 and a half years old? How do I make sure my money is safe? How do I make sure that my money has a decent rate of return? And number four, my money has significant tax advantages. We call this the laser test, LSRT. So anybody asks you, hey man, you should put your money away here, put your money away there, put your money away, yeah, does it pass my laser test? And by the way, there's a video right here, we call that the 4 homes of money, okay? So watch this video here. If anybody ever tells you to put your money somewhere, you now have a system by watching this video to help you make educated and aware choices of what to do with your money. Again, I'm not a financial advisor. I'm just educating you on some of the questions you need to be asking yourself to process this so you have a formula to make better educated decisions. Okay, so back to the ledger. As an example, you're gonna have one column here and a second column here and a third column here. One column is gonna say guaranteed column. Second one is most likely your non-guaranteed column. The third column is your death benefit column, okay? Different insurance companies illustrate it differently, but this is generally what they would show inside an illustration. So in this example, we got $3 million coming to a policy where $600,000 a year, $600,000 a year, $600,000 a year, $600,000 a year is in this example, okay? And then for the rest of the policy years, the rest of the life of the policy, I'm presuming WAKA FLOCKA would put 0 into the policy. In this example, he's putting away $3 million in a 5-year period, okay? He's putting $600,000 over a 5-year period in this example. Now, in a guaranteed column, the insurance company is going to say, okay, this is the most amount of money we can charge you for cost of insurance. And this is what's going to happen when we do not credit you the highest amount of interest. The minimum we can credit you on the policy, contractually speaking, inside the contracts, this is what your money is going to look like. The non-guarantee says, well, this is what we're going to charge you based on current costs of insurance, not maximum cost of insurance, that is in guaranteed column. But in column 2, it says, this is going to be the current charge we have with cost of life insurance based on your age and your gender and your health rating, whether you're standard, a non-tobacco rating or preferred elite rating means you're the healthiest, so therefore your cost of insurance is the lowest. But this is this is the cash value, what's going to look like as an example. By the way, don't hold me to these numbers. These are just general ballpark numbers of what you should see inside a life insurance contract if this is something you want to do. But there's guaranteed and non-guaranteed based on current interest rates the policy is crediting, based on current projections if it's an index universal life that is going to project. And by the way, there's specific rules now inside index universal life contracts based on certain regulations that were passed to make sure your insurance agent is not overselling and overinflating what they can illustrate inside the cash value accumulation side of life insurance policy. So you make sure your insurance agent knows about that law. If they don't know the law, then that agent isn't trained in the strategy. They should know. And probably I'm doing the homework for the insurance agent watching this because, listen, I know my competitors watch this as well. So listen, I don't care if my competitors watch this. I want to help the industry. I want to help people out there with their finances. I want to help our industry increase its game so therefore it can serve and help more people. Because the challenge today is that in terms of life insurance, the challenge today is not that people don't have the right type of life insurance. That's not the challenge we have today. The challenge we have today is people don't have any insurance, period. Okay, that's the biggest challenge we have. The massive amount of uninsured people. And you got to rely on GoFundMe's and all that type of stuff, which is never supposed to be created for emergency and or death benefit purposes. But back to this, let me get off my soapbox. Based on this column now, as this money grows and accumulates, because there's a couple phases. There's a contribution phase, and then there's accumulation phase, right? And now there's a distribution phase. And another phase we'll talk about later on, which is transfer phases, which is why my wife and I have wills and trusts, and we sat down with an attorney to make sure all of our assets and life insurance and everything that we own goes into a trust. Okay, we sat down with our attorney, we got it all drafted up to make sure we become tomorrow's old money. How many of you guys want to become tomorrow's old money? Amen? Put it in the comment section below. I am tomorrow's old money. Put it in the comment section below if you believe that is you. Okay, so you put your money, WAKA FLOCKA is putting money in. Okay, this is you. It doesn't have to be 600 grand, it doesn't have to be 3 million bucks. It could be $200,000-$300,000. It could be $20,000 to $30,000. It could be 5, 10, 15,000. Whatever. It's all relative to you and what you want and what you're looking to accomplish. But I'm just taking it from his scenario. I presume that this is usually the strategy what's happening. He's putting $600,000 for 5 years into this policy, and the ledger will show a guaranteed, non-guaranteed column based on current interest rates and guaranteed interest rates inside the policy. And based on that amount of money, he'll qualify for a certain amount of death benefit. Now, I have zero clue what the death benefit is for WAKA FLOCKA. I'm not sure exactly how old he is, what type of health he has, and which type of death benefit he qualified for. A typical example would be if he's putting $2 to $3 million in here, and he's probably most likely, what is he, in his 30s? Somewhere around those lines, probably in his 30s? Like mid-30s, and most likely qualify for a healthy death benefit. So if he puts $2 to $3 million into a policy, he'll qualify for and he gets qualified for the policy, the death benefit is going to be a $10 million policy. Now, the knock on this, a lot of people say, hey Matt, the challenge I've heard online is that when somebody passes away, beneficiary receives the death benefit, but none of the cash. That's true under option A. But if you are an insurance agent, if you're working together with your insurance agent that knows this stuff, ask them for option B, or what they call an increasing death benefit, because the policy is also going to include not only the death benefit, but also the cash that's inside the policy. So if something were to happen to WAKA FLOCKA, and he chose option B on his insurance policy, he'll not only receive, in this example, a $10 million death benefit, but let's say he's got $600,000 inside the policy. He's also going to see whatever cash value that's also inside the policy, so it's a combined benefit. So this is how you accumulate money inside a life insurance policy. We're going to put money in over a 3, 4, 5 year period. You're going to have a guaranteed column, you're going to have a non-guaranteed column, and you're going to have your death benefit. So all this money grows. Let's say WAKA FLOCKA's money grows here to $12 million bucks. Okay? Now the thing here, notice is all the way down here. Because money that you put inside a policy, his borrow from that, what he didn't say in that video was when. When? Now, I'm not so sure if he's going to borrow in the first year, second year, third year. Not advised to do that, because you want to treat a life insurance policy like a bank or a checking account. You want to have what they call a capitalization phase. You want to capitalize your life insurance policy, so therefore you can finally get inside the policy and start earning a rate of return. So therefore it can grow and start compounding. What you also have to look at is the insurance companies also have cash surrender values that's inside the policy. In other words, for a period of time and declining over a period of time, for the first 10 to 15 years with most life insurance contracts, they will not allow you to touch all of your money all at the same time, especially at the beginning. So the surrender charges, a lot of people say, well, you know, life insurance has a lot of charges. A lot of times in life insurance, those charges only apply if you surrender the policy, which is something you should not do when you set up this type of strategy. In other words, if you set up the strategy, you should have the mindset to die with this policy in force. That you're not here to set up the policy and then pull the money out and then close it like you treat it like a credit card or a bank account. And you have to ask yourself why. Why are such great tax provisions within inside the life insurance industry? Well, how come the 401k don't have this? How come a 403b? How come cryptocurrency don't have it? How come real estate don't even have this? But think about the good, the social good that life insurance does for the community. And you have to look at tax codes. You got to look at tax codes and say, what is the incentive? Uncle Sam, what are you trying to get me to do? So for example, in society, if there's an entrepreneur that's taking on the most risk, he's putting all his money on the line, he's putting his credit on the line, time and effort and energy to create jobs, to create products and services that the government could not do. Guess what the government in return exchanges to the entrepreneur? Well, if you're going to take on all that risk, we're going to give you certain tax provisions. The government says, listen, if you take care of yourself, if you financially take care of yourself, if you buy a life insurance policy and then under IRS code 101A, all this money here, this death benefit, you don't have to pay a dime in tax. Why? Because you took care of yourself. And if you take care of yourself as a private citizen, you're not going to be sitting in my line for Section 8. You're not sitting in my line at Social Security. You're not sitting in my line for other government benefits, island card or food stamps, et cetera, et cetera. You're not dependent, bottom line, on the bottom line because you as a citizen took care of yourself and you took care of your family. That's why we allow you certain tax provisions to take advantage of if you as a citizen do so. So if you are educated about what life insurance can do, forget this fancy strategy here. Think about this. Do you want to leave your family a financial inheritance? Do you want to leave the people that you love and care about a financial head start much greater than when you had when you were coming up? Do you? Well, that's what life insurance does. So back to the strategy. Now this is all set up. Right? WAKA FLOCKA's got $2 to $3 million into this thing. He's funneling it over a 4 or 5 year period. He's in alignment with the tax guidelines of TEFRA, DEFRA, and TAMRA. Now this policy is deemed tax advantaged. He either has index universal life policy, universal life, or whole life policy. Okay, now he's got 12, let's say for example, he's got $12 million into this thing. Woo! Okay? If you had this money inside a brokerage account, what are you paying every year? And it's not inside an IRA or what they call a qualified plan. You have to pay tax. Every time you make money inside your brokerage account, you buy and sell stock, capital gain, offset by the capital losses, you have to pay now taxes. You have $20 million inside there, inside a 401k or a 403b, you deferred taxes your entire life. Now you got to pull this money out. Guess what you got to pay now? If this $12 million was inside these different tax structures, you have to pay tax. Well, guess what tax strategy allows you to grow your money tax-free, to accumulate your money tax-free, and withdraw your money without paying a dime in tax. And then something happens to you, the money blossoms in value to your next generation without paying a dime in tax. Well, guess what? That falls under IRS code 7702. Who lives inside IRS 7702? The life insurance industry. What a great industry, right? So here, in this scenario, now, if you got $12 million, how do I get my money? Show me the money. Okay, great. Now let me get my money. Here are 3 ways to get money out of your life insurance policy. 1, sad way. 2, dumb way. 3, smart way. Let's go with sad. Now, if something happens to WAKA FLOCKA, sadly, something happens to a policyholder with an in-force contract, sadly, when they pass away, they will receive the death benefit. In this example, a $15 million death benefit. So sadly, to get money out of the policy, somebody sadly has to pass away. Somebody has to die, which is a traditional way of where people thought life insurance policy was all about. Now here's another thing, another sad way, but not so sad, especially if you're going through it. Let's say you had a heart attack, stroke, cancer, or you're older in age, you can't take care of yourself, you need some home health care. Or you got injured on the job and you can't take care of yourself, you need somebody to help you around. Well, you can qualify for a critical illness benefit if the properly structured life insurance policy has living benefit provisions in it. It's part of the, by the way, there's not a lot of life insurance companies that offer it or have it, just so you guys know. Or one way you can get your money from the policy is if you are deemed terminally ill. But again, that is a sad way to get money from a life insurance policy. But it is a way to get money from a life insurance policy. The second way is a dumb way, okay? Which is to withdraw. Okay, I got $12 million in there. Let me withdraw my money. That is a dumb way. Why is that a dumb money? Because a couple things here happen. FIFO means first in, first out. Okay? So your principal is taken out of the policy and then your interest. Okay? And so what happens is if you pull this money out via a withdrawal, you permanently reduce the cash value and death benefit within inside the policy, and to be able to put that back in via after a withdrawal is very difficult because you permanently then reduce the cash value and death benefit by creating a withdrawal. Now you can take money out from your policy as a withdrawal, but it is the dumb way to do it. The other way, it's not the smart way, is basically loan from the policy. People say, well, why I got a loan from my life insurance policy? It's my money, right? Well, it's funny how people have that knee-jerk reaction when they do the same thing with real estate all the time. Oh, Matt, you know, I bought this house at $100,000. Now it's worth $500,000. I got $400,000 equity. Well, how do you get it out? Well, I can sell the house, get the $400,000, or I can stay in the house and do a cash out withdrawal, cash out refinance, and strategically refinance the house and take out the equity inside the house, even though my mortgage payment goes up. But now I have control of the equity. Now I can go invest into more real estate. People don't think it's a knee-jerk reaction to loan to get equity out of the house to buy real estate, but I think it's weird that you loan from a life insurance policy. Well, the nomenclature of loan for a life insurance contract helps you strategically because money that is loaned from a life insurance policy is not deemed as either earned, passive, or portfolio income, therefore non-taxable. Because you don't get taxed on money you get from a loan. So when you loan money from a policy, let's say you want to take, in this situation, $1 million from a $12 million cash value accumulation within inside a policy. The dumb way is to withdraw $1 million, okay? Because dollar per dollar, you lose cash value and death benefit from the policy day one, okay? You lose $1 million. Or you can loan it from the policy. And here's what happens. Here's a cool thing about the smart way of loaning money from a life insurance policy. Unlike money that you might have in a brokerage account, money that you might have inside a 401k, money that you might have inside a 403b or 457 plan. When you loan from those type of scenarios, those type of tax structures, the company actually has to sell your position in the stock market that day. So that's why they tell you at the close of business, we'll sell your stock and then we'll send you a check, okay? So what happens is whatever your value or whether the stock market value of your portfolio was that day, they have to sell, in this case, $1 million of stock, okay? So you lose your position in the market. So you lost some gains and some advantage you had with dollar cost averaging. Basically, you have to sell your positions in the stock market in your 401k or 403b plan, your brokerage account, to get the $1 million out, okay? And then in those plans also too, you have to pay them back. Otherwise, it becomes a taxable distribution. If you don't pay back your 401k loan, you won't pay back your retirement plan on these things. Now here inside a loan, in an insurance policy, you do not have to pay it back. So what the insurance company does, they set aside $1 million, okay? They don't sell your position in the market. They allow you to loan $1 million loan and you collateralize the cash value you have inside the policy without selling your position. In this case, if you're talking about an index universal life policy, they don't sell your position inside the index of the gains or the loss of the stock market. They don't sell your position wherever you're at that particular point inside the stock market. Which, by the way, an index universal life is not a security, which means it's not a typical stock, bond, and mutual fund. You're doing this through the transactions of the insurance company, and this $1 million is basically collateralized through your death, which will be payable through your death benefit upon your passing. In the meantime, the insurance company charges you 4% for the loan. So in this case, they're charging you 40 grand. But since they collateralized your $1 million payable back by the death benefit, your $1 million is actually still growing in cash value. So it's also being credited 4%. And so one of the things that insurance companies do, then they have this provision called the zero cost wash loan. So to just let you know, what could you do with the $1 million from your policy? You can fund a business. You can fund and buy more real estate. You can take advantage of opportunities that might come your way. In a case in music, he might fund his next record or records, sign on his new artists through getting a loan from his own life insurance policy because he initially funded it with $2 to $3 million. allowed it to earn a rate of return, allowed it to earn an interest rate, and through the interest he's earning through the life insurance contracts, he's able to loan it back out of the policy without paying a dime of tax and fund his next deal or opportunities. So there's some sexy things that is happening, and I'll tell you this. I don't know what's going to happen in our country in the next 3, 4, 5 years. All I know is most likely going to be scary and very rocky. And for those that take advantage of what they have today, I don't know if you have a lot of money inside your savings. I don't know if you have a lot of money inside the equity of your home. I don't know if you have a lot of money sitting on the side somewhere not doing anything. But these are some of the things that you need to consider thinking about after watching the video. Again, it may not be me, all good. But talk to somebody. Surround yourself with wise counselors and advisors to help you understand what your advantages are in an industry where a lot of people thought it was just for dying. There is the word life in the word life insurance, and therefore you should take advantage of it when you are alive. Young and healthy, take advantage of this if you can, if it's suitable and appropriate for you. And for a lot of people, it's not. So when you're looking at this, this is not a get-rich-quick strategy overnight. Please don't treat this like a bank account or a credit union account or a credit card. This does take some time to ramp up. Some fancy words a lot of people call this strategy. They call this infinite banking. Okay, missed fortune, right? Max funded, be your own bank, right? There's all sorts of different marketing terms to talk about what this does. But basically, when you see those kind of buzzwords in the insurance industry, this, generally speaking, this is what they're talking about. So I've been doing this now for 23 years. I've been specifically training this stuff since 2005, and something we've done across the country for clients over and over and over and over again. And one of my favorite clients is my mom. We always say in the financial services world, don't ever put your client's money into something that you wouldn't trust your own mother's money into. So again, these are my life insurance policies. That's not for my clients. This is our family. It's my children. It's for my wife and I. We got multiple policies because we have multiple needs and multiple time frames that we want to use those policies. Matt, why all the different life insurance policies? Because I started off these life insurance policies when I was broke. Some of you guys think that you need to be rich to start this. I started this when I had only $150 a month to tuck away. And then I started making more money, and $250, and I started making more money, and $350. I started taking more money and it became $750. I started making more money and it became $1,000 a month, and became $2,000 a month. And I needed to get another policy because I bought a house, my responsibilities changed. I had 1 kid, 2 kids, 3 kids. I get another policy because I started filling up these policies because I was gonna start conflicting with the TEFRA guidelines of overfunding a policy. And that's why I needed to get another policy, or some of the policies have actually just increased my death benefit, and some of that's starting from scratch all over again. But these are some of the things that I hope that you start thinking about when it comes to this beautiful world of financial literacy, awareness, and implementation to get you to where you want to go. Again, make sure cash flow is established, because this is nothing if you don't have consistent cash flow and security of your income, because this right here can implode if you end up spending down your money too soon, too fast. So that's the danger of this too as well. If you end up spending this money too soon and you don't completely fund it altogether with what you thought it'd be, it's not suitable and appropriate for you. So with that being said, guys, check out these 2 other videos right here of me having conversations with insurance gurus in the insurance industry. I've always loved taking what the rich and the wealthy have done for generations and generations and filtering it down to the multicultural middle class. Big passion of mine, and the reason why I lead a national life insurance organization, because we want to establish this in America. Establish a solid financial foundation. I've been doing this now for 23 years, and the problem I saw back then is now not even closely to being solved. Actually, it got worse. So that being said, guys, I'd love to know your thoughts, your questions, your feedback. Put it in the comment section below. If you think that this video has provided a little bit of value to you, please consider hitting like. If you watched a couple of our videos, and if you've done so already, you have not done so already, please consider hitting subscribe and hit notifications to be alerted the next time we upload our next episode. From Dallas, Texas, I'm your money smart guy, and until we meet again, continue to live smart, continue to live smart, and be money smart today.